Thanks for listening to this audio summary of the June 2025 Assured Briefing. I'm Bill Wilt, and I'll talk you through the main points of this month's briefing. Our first note is called Here's What to Look For If a Recession Happens. Of course, we don't know whether a recession will happen or not, but clearly the chances are higher than they were a few months ago. And most will have heard our expression that the P&C industry is recession resilient, but not recession proof. The relative inelasticity of P&C premiums and fewer claims during recessionary times are part of that formula. And in our May briefing, we introduced another defensive attribute of P&C insurers, which is that investment income oftentimes increases when the yield curve inverts. In turn, that happens oftentimes before a recession. But in this note, we examine the relationship between P&C written premium and the combined ratio and industry, that is sectors of the economy, industry GDP growth across 15 different sectors of the economy, data with data going back to 1952. The conclusions are that written premium growth and the combined ratio during expansion years, economic expansion years, and years touched by a recession, they're barely different, although premium growth is a bit slower and the combined ratio a bit higher during years touched by a recession, but the difference isn't statistically significant. And whereas you could make this statement, as goes GDP, so goes P&C written premium growth, our work shows that you can refine that and say that as goes the retail and construction industry, so goes P&C written premium growth. Our work shows that the construction industry, which buys the most commercial insurance premiums, and retail trade, which is maybe more like sixth on the list, those are the two industries most highly correlated with P&C premium growth. We'll be watching those in 2025. And our note also shows the specific products purchased by those industries, with thanks to our friends at Verisk's Market Stance business unit. Our second note measures the efficacy of advertising with a look at the market share gains, underwriting results, and advertising spend of the top 10 auto writers. Over the last 3 years, Progressive has gained share while spending more on advertising, and it's enjoyed very profitable results. Now, it might surprise you to learn that Geico has lost share over the last few years, although their advertising spend has stayed flat relative to premium, and they've produced tremendously profitable results. State Farm is somewhat the mirror image in that they've gained share, which might surprise some, but they've also advertised less and they've endured meaningful underwriting losses. There's more in the note. Our third note considers the relationship between workers' compensation and Medicaid in states that expanded Medicaid coverage under the Affordable Care Act and the 10 states that did not. Now, the reason for revisiting the topic is because of the possibly meaningful changes to Medicaid that could come out of the federal budget discussion. The bottom line is that whereas a few years ago we were of the view that Medicaid expansion was a mild tailwind to the workers' compensation loss ratio, our review of the data now suggests that it's actually hard to tell the difference in workers' compensation loss ratios between the states that expanded Medicaid and those that did not. That's what the data says anyway. It's our intuition that if a meaningful number of people lose Medicaid coverage as a result of the budget negotiations, that seemingly has to increase the potential number of workers' compensation claims. Now, it also seems reasonable to think that those claims, which must be fluid enough to be reported under one versus or the other system, they could be generally less severe and perhaps medical only claims, which might explain why there seems to be little difference between the loss ratio of states that expanded Medicaid versus those that did not. We include a note in the briefing that folks in the reinsurance industry might like, or they might not, because it shows the amount of adverse development shown as ceded by accident year and line of business to reinsurers, and compares it to the gross and net adverse loss ratio development points, or loss ratio development points, most of which has been adverse over the last decade. The bottom line is that most of the liability coverages we've examined, most of those we're looking at now roughly a decade of ceded adverse development points being higher than gross adverse development points. Lots of graphs in that note. For the second year, we've used two methods to allocate surplus to major lines of business, and then examined the returns on surplus, which include both underwriting and allocated investment income. We've done that for the top 10 writers in each line of business. The quick summary is that homeowners' returns have been variable, but produce low single-digit returns on surplus over the past 10 years. Interestingly, private passenger auto liability has actually produced a median return on surplus near 0%, because the last 10 years have included 4 very difficult years. But it might be surprising too that private passenger auto physical damage has produced some knockout returns, and particularly in 2024, where we measure returns on surplus greater than 40% on an 86% combined ratio. That's the median combined ratio, lower for some companies. It's entirely possible that our method doesn't allocate enough capital to that line, but even if capital were to be increased by 25 or even 50%, returns on private passenger auto physical damage would still have been very high in 2024. And it'll surprise absolutely nobody that returns on workers' comp have been really strong, with returns on surplus north of 20% and commercial auto liability very weak and negative in several years. And last, for those who are financially oriented, we ask the question of whether valuations in property casualty insurance are still dominated by the combination of price to book and ROE metrics, or whether the price to earnings and revenue growth measures are starting to take hold. After a comprehensive review of some 45 publicly traded insurers, we conclude that for most subsectors of the industry, by which we mean personal, reinsurers, and standard commercial writers, the combination of price to book and ROE still dominates valuation. But for specialty insurers writing E&S business, revenue growth and the price to earnings multiple have rivaled the utility of the other metrics over these past several years. Now, whether that'll continue to be the case as the pricing market softens across many lines of business, that remains to be seen. Well, that's it. We hope you found this summary useful. As a subscriber, please remember that you can forward our emails to your colleagues and we'll admit them to the distribution list. All they have to do is fill out that dial at the bottom of each email. Thanks again. We hope you have a great rest of your day.